December 31st, 2025. I'm sitting here on New Year's Eve and I can't stop thinking about what just happened to silver. A year ago, it was trading at $36. Tonight, $89.73. That's a 148% gain in 12 months. My neighbor Bob stopped by earlier. "Hey, remember when you told me to buy silver last year?" he said, grinning. "Best advice I ever got. But what happens next? That's the question everyone's asking. And honestly, what I'm seeing in the data keeps me awake at night. Because everything that drove silver up 148% this year is getting stronger, not weaker. Think about it. China basically shut off their silver exports. The big commodity exchanges are running out of actual metal. Every solar panel, electric car, and smartphone needs silver, and they're making more of those than ever. Meanwhile, people are finally waking up to the fact that you can't print silver like you can print dollars. I've been running the numbers for months now. Every model I build shows the same thing. Silver hits on $100 in the first quarter of 2026 and averages around $150 for the whole year. Bob's eyes went wide when I told him, "You're serious? Another 70% gain after it already doubled?" "Yeah, I'm serious. And here's why I think those numbers might actually be conservative." What's really going on? Here, look, when Bob asked me what happens next, I had to explain it like this. Remember how your gas station ran out of gas during that hurricane? Same thing's happening with silver, except the hurricane isn't going away. Here's what most people don't realize. Silver's 148% rally in 2025 wasn't some speculative bubble. It was the market finally waking up to reality. And that reality is pretty simple. We're running out of silver while needing more of it than ever before. China basically said no more. Back in January, China just stopped exporting silver. Imagine if Texas suddenly said no more oil exports. That's essentially what happened. China produces about 14% of the world's silver, and they just kept it all for themselves. That's like closing down the 3 biggest silver mines on Earth overnight. My friend Sarah works in procurement for a solar panel company. "It's crazy," she told me last month. "We used to get calls from Chinese suppliers wanting to sell us silver. Now we can't buy any at any price. They're keeping everything for their own factories." The warehouses are getting empty. You know how grocery stores looked during COVID? Empty shelves everywhere? That's what's happening in the silver world. The big commodity exchange in Chicago started the year with 102 million ounces of silver in their warehouses. By Christmas, down to 23.7 million. That's like your pantry going from full to almost empty in 12 months. Everyone needs silver, nobody can cut back. This is the crazy part. Unlike oil, where you can drive less when prices go up, you can't really use less silver. Every solar panel needs it. Every smartphone needs it. Every electric car needs 3 times more than a regular car. It's not like companies can say, let's use half the silver. The gadgets just won't work. My buddy Mike runs a small electronics company. When silver was $36, it was maybe 2% of our costs, he explained. Now at 89, it's 5%, but we can't make our products without it. So we either pay the higher price or go out of business. That's the thing. When something is truly essential and you can't substitute it, price becomes almost irrelevant. You pay what you have to pay. Why this pattern? Always leads to explosive prices. When Bob asked me how I knew silver would keep going up, I told him about some history lessons that really opened my eyes. The oil crisis of the 1970s. Back then, oil was $3 a barrel. Cheap, plentiful, nobody worried about it. Then some countries decided to stop selling oil to America. Boom. Oil jumped to $12 overnight. People thought that was crazy expensive, but here's the kicker. That wasn't the end. It was just the beginning. Over the next 6 years, oil kept climbing until it hit 35. That's another 192% gain on top of the initial shock. My dad lived through that. He told me, first, we were mad about paying $12 for oil. Then we would have been happy to pay $12 when it hit 35. The initial shock was nothing compared to what came after. Gold in the 1970s. Same pattern. When Nixon ended the gold standard in 1971, gold went from $35 to $200 over 5 years. That seemed massive, a 471% increase. People thought gold was done. Nope. From 1976 to 1980, gold exploded from $200 to $850. That's another 325% gain on top of the original rally. My uncle bought gold at $300 during that run. Everyone told him he was crazy, that he'd missed the boat. 4 years later, he could have sold for almost 3 times what he paid. The recent palladium story. This one's fresh in everyone's memory. Palladium doubled from $500 to $1,000 between 2016 and 2018. Car companies use it in catalytic converters, and Russia controls most of the supply. Then came the real fireworks. From 2018 to 2020, palladium went from $1,000 to $2,800. Automakers were literally panicking, paying any price they could get. Here's what I learned from all these stories. The first big price jump is not the main event, it's just the warm-up act. The real explosion comes later, when everyone realizes the shortage isn't temporary. Silver's 148% gain in 2025, that was our warm-up act. The numbers that keep me up at night, Bob, wanted to know exactly why I think silver hits $100 by March and averages $150 for the year. Fair question. Well, let me break down the math in plain English. We're short 347 million ounces. In 2025, the world needed about 1.2 billion ounces of silver, but only produced 853 million ounces. That's a shortage of 347 million ounces, the biggest gap we've ever seen. To put that in perspective, it's like if America needed 347 million gallons of gas, but we only produced 0 gallons. We had to get it from somewhere, and that somewhere was existing stockpiles. 2026. Looks even worse. My friend who tracks this stuff for a living showed me the projections. Supply is expected to drop another 12%, while demand jumps 28%. That puts us short about 420 million ounces. It's like musical chairs, she explained. Every year, we remove more chairs, but add more players. Eventually, someone's left standing. People are hoarding instead of trading. Here's something interesting. In normal times, silver changes hands pretty regularly. Traders buy and sell, dealers move inventory around. But in 2025, that trading activity dropped 67%. Know what that means? People who bought silver aren't selling it. They're keeping it. It's like when people started hoarding toilet paper during COVID. Except this time, it's wealthy investors and foreign governments hoarding silver. The crypto money is coming. Remember when Bitcoin hit $100,000 and everyone thought they were geniuses? Well, crypto lost $800 billion in value during 2025. That's a lot of disappointed investors looking for somewhere else to put their money. My financial advisor told me, I'm getting calls every day from clients who want out of crypto and into something real. Gold and silver are at the top of their list. We're talking about maybe $200 to $400 billion flowing out of crypto. Even if just 10% goes into silver, that's $20 to $40 billion in new buying pressure for a market that's already stretched thin. China is buying everything they can find. While China stopped selling silver to the world, they're buying massive amounts for their own people. Internal Chinese demand jumped 340% in 2025. That's like if California suddenly needed 3 times more water, while also stopping all water exports to other states. The math just doesn't work. The hidden mechanism, why $100 Q1, $150 average, is conservative understanding why silver will reach $100 in Q1 2026 and average $150 for the year requires grasping the mathematical inevitability of price discovery when synthetic supply meets physical demand. The Q1 catalyst convergence, multiple catalysts converge in Q1 2026 that will force immediate price acceleration. January, annual Chinese export quota decision, expected to maintain restrictions. February, major solar panel production increases requiring silver inputs. March, COMEX contract expiration with record open interest and minimal deliverable inventory. Any of these catalysts alone could drive silver above $100. All 3 occurring within 90 days makes 100 plus virtually guaranteed. The industrial panic threshold. Manufacturing companies have tolerated silver price increases from $36 to $80 by adjusting margins and raising product prices. But 100 plus, silver crosses the threshold where companies begin panic stockpiling to ensure supply continuity. When industrial panic buying begins, it overwhelms all available supply regardless of price because companies cannot risk production shutdowns that cost more than expensive silver procurement. The investment momentum acceleration. Silver's 148% gain in 2025 attracted massive institutional attention while demonstrating superior performance during economic uncertainty. As more institutions allocate to silver during Q1 2026, buying pressure creates self-reinforcing momentum. Unlike retail investors who buy small quantities gradually, institutional buying occurs in massive blocks that can absorb entire dealer inventories within days, creating supply shortages that force dramatic price adjustments. The arbitrage opportunity. Elimination, physical silver premiums averaged 8 to 12 over spot during 2025 as dealers struggled to source inventory. When spot reaches $100, premiums could reach $20 to $30 as the gap between paper and physical markets becomes unbridgeable. This premium expansion effectively creates 2 silver markets, paper contracts trading around $100 and physical silver trading around $130, forcing paper markets to either deliver physical metal or lose credibility completely. The $150 average mathematics For silver to average $150 during 2026, it needs to trade in the 120 or 180 range for most of the year. This requires Q1 rally to $100, $120 range. Q2 consolidation around $130 or $150 range. Q3 push toward 160, 180 range. Q4 volatility around $140, darker now $170 range. This progression assumes continued supply constraints, steady industrial demand growth, and moderate institutional investment flows, all conservative assumptions based on current trend analysis. The conservative nature of $150. Many analysts consider $150 average silver optimistic, but mathematical modeling suggests it may be conservative because historical commodity explosions typically deliver 300 to 500% gains from breakout levels. Silver's industrial demand is accelerating faster than any previous cycle. Monetary debasement is occurring at unprecedented scales globally. Available supply is contracting while demand is expanding exponentially. If these trends continue, $150 could represent the midpoint of a range that extends significantly higher. Eruption scenario, the 2026 silver timeline. Based on supply-demand fundamentals, institutional positioning, and historical precedents, here's how silver's price explosion will unfold throughout 2026. Q1 2026. The $100 breakout, January-March. Silver opens the year around $90 and immediately faces multiple catalysts that drive prices through psychological resistance at $100. Chinese export restrictions confirmed for another year while domestic demand surges. Solar panel manufacturers begin 2026 with massive production increases requiring silver inputs. COMEX faces delivery crisis as March contracts expire with insufficient inventory. Price action, $89, so $108 in Q1, with daily moves of $5 or $8 becoming normal. Q2 2026, the industrial panic, April-June. Manufacturing companies recognize that silver shortage is permanent rather than temporary and begin strategic stockpiling regardless of price. Electronics producers, medical device manufacturers, and renewable energy companies compete for limited supply. Physical premiums explode to $25 to $35 over spot as dealers run out of inventory. Price action, $108, $145 in Q2 with increased volatility and supply shortages. Q3 2026, the institutional flood, July-September. Sovereign wealth funds and pension funds begin major silver allocations as superior performance becomes undeniable. Crypto capital rotation accelerates as institutional investors recognize hard assets provide better protection during monetary crisis. Central bank silver purchases increase as alternative reserve assets. Price action, $145, $175 in Q3, with momentum-driven buying creating sustained uptrends. Q4, 2026, the parabolic phase, October-December. Silver enters parabolic phase where price discovery breaks down due to genuine scarcity combined with panic buying. Physical markets decouple from paper markets entirely. Industrial users offer premium pricing for guaranteed supply. Investment demand overwhelms remaining available inventory. Price action, $175, 200 plus with extreme volatility and potential temporary supply shortages. 2026, average $152 per ounce. Mathematical average of quarterly ranges produces $152 average for the year, confirming conservative nature of $150 estimates. The warning. Positioning for the explosion. The expected silver price explosion in 2026 represents both unprecedented opportunity and significant risk, depending on positioning and understanding of the underlying dynamics. For early positioned investors, those who accumulated silver during 2024-2025 at prices below $50 face life-changing wealth creation if the explosion unfolds as projected. Silver holdings could increase 300-400% from acquisition costs while providing protection against monetary debasement. Key strategy, hold core positions through volatility while potentially taking partial profits above 150 to reduce risk exposure. For new market entrants, investors entering silver markets in 2026 face higher prices but still significant upside if supply-demand fundamentals remain intact. Entry timing becomes critical as daily volatility increases. Recommended approach, dollar cost averaging into positions during temporary pullbacks while avoiding leverage that could trigger forced selling during volatility spikes. For industrial users, companies dependent on silver inputs face existential challenges as material costs could triple or quadruple during 2026. Strategic procurement becomes survival critical. Essential strategies, forward contracting with suppliers, strategic inventory building, alternative material research, and product pricing adjustments to maintain margins. For institutional portfolios, silver, as expected performance makes allocation consideration mandatory for institutions seeking inflation protection and portfolio diversification during monetary instability. Portfolio integration, 5 to 15% allocation, depending on risk tolerance, with emphasis on physical holdings, rather than paper derivatives that may face delivery challenges. The timing considerations. Silver's explosion is expected to occur rapidly during 2026, leaving limited time for optimal positioning. Unlike gradual bull markets that allow extended accumulation periods, commodity explosions create narrow windows for participation. The risk management reality. While upside potential is extraordinary, volatility will be extreme with daily moves of $10 to $20 becoming normal during parabolic phases. Risk management through position sizing and profit-taking strategies becomes essential. The physical versus paper choice. The expected explosion will likely break paper-silver markets as delivery obligations exceed available inventory. Physical ownership becomes critical for participation in genuine price discovery. The individual decision. For ordinary investors, 2026 represents the opportunity to participate in what could be the greatest commodity explosion in modern history. But participation requires understanding that explosive markets reward the prepared while punishing the unprepared. The mathematical foundation for silver's price explosion is solid. The supply-demand imbalances are real. The institutional flows are beginning. The geopolitical catalysts are accelerating. Silver's 148% gain in 2025 was preparation for the main event. 2026 will be the year when silver transitions from precious metal to strategic asset, from investment option to monetary necessity, from gradual appreciation to explosive revaluation. The explosion is mathematically inevitable. The timeline is accelerating. The positioning window is closing. Those who understand the mathematics and position accordingly will benefit from the greatest wealth transfer in commodity market history. Those who wait for confirmation will discover that explosive markets move too fast for late entry at reasonable prices. The countdown has begun. The explosion is imminent. The choice between participation and observation must be made immediately. 2026 will be the year silver changes everything. Be ready.